Good morning to all. Welcome to Vista Science Scientist School. Happily welcome to online class 12th standard commerce. Last class we have discussed capital market, meaning primary market and types, secondary market, public issues like that. We are discussed in this class. Now we are going to be discussed about today we are going to discuss about Indian capital market, that is an evaluation and growth of capital market, how it has been introduced in India, what is the evaluation, how it has been origin from India, and what is the growth period in India. After independence 1947, after the independence only, the Indian economic growth, they think about the economic growth of India. After the implementation of, after the freedom got, after the independence, they think about the economic policies and new economic policies like that. The period of 1947 and 1973, the market developed of infrastructure of capital market. That is an initial stage, that is a priority and primary stage in India. They developed the capital market. The period of 1947 and 1973, the market developed of infrastructure of capital market. During the period, a network of a development of financial structures such as IFCI, ICICI, IDBI, UTI, SFCs, SIBCS were established. These are the financial institutions. These are the banking financial institutions. They are providing loans to the industrial sector. Important thing, they are providing loan to the industrial sector. These are the financial institutions, strengthens the capital market. They are providing the strength. They became a backbone to the capital market. During the period of 1980 and 1999, after the globalization, that is after the implementation of LPG. During the period of 1980 and 1999, the debentures emerged as a powerful infrastructure of resources. Mobilization is the primary market. The public sector bonded were being introduced. A number of stock exchanges come into existence. These were the momentum growth in a secondary market. In secondary market, after the implementation of 1947 and 73, they are impacting the more major impact in capital market. Next, new financial institutions. After that, implementing the new financial institution. A number of the institutions of a financial having established to cater the credit requirement of a various segment of industries are needed. A brief outline of these institutions is presented below. The venture fund institution, that is, venture means capital fund institutions. Capital fund institution means they are providing a capital to start in industries. The venture capital financial is a form of a equity financing residing there, especially for funding of new and innovative project areas. Venture capital funds bring into a force that high technology and project which are converted into a commercial product. Which are converted into a easily commercial product. Venture capital is a financing in a forms of equity and financial decided especially for funding of new and innovative project ideas. Venture capital is a fund bring into a high-tech project were converted into a commercial production. These are the venture fund institutions. Next, mutual fund. Mutual fund is a small saving investors fund. Mutual investment is a providing facilities for chancing the small of saving of small investor into a venture of providing the investor in small mutual fund. A mutual fund company is invested the fund of pool of shareholders and benefits of their diversity investment in portfolio and reasonable returns. They are following the small investors who are providing the small investment are based on the investment sector. The small investment means the small investment sector persons. And next, Factoring institution. Factoring is the arrangement in 11th standard itself. You might have studied the factoring. Factoring is the arrangement whereby a financial institutions provide a financial accommodations on basis of a assignment. The sale of accountability is received. The factoring institutions collect a book of debit on the behalf of its client. Some of the factoring institutions operating in India are SEBI factors and the commercial service of private limited as a subsidiary of State Bank of India and the commercial bank factors is limited as a subsidiary of commercial bank. These are the factors institutions. The factors institutions are provided the major impact of a service private limited, commercial service private limited. They are providing a subsidiaries. And next, over counter, that is OTCEI. This is an important 2 mark question. Over the counter exchange of India, out of the Indian dollars. OTCEI was a setup of the premium primary institutions to allow the trade of the securities across the electronic ground through the country. The address is then some specific problem of both the investors or medium size of companies. Some of the greatest symptoms of the OTCEI is a transfer quick deal, fast settlement, and better efficiency. Throughout the world, now we can trade anywhere at any time. It is a through OTCEI. And this is an National Stock Exchange of India, NESEI, was established in 1992. The function is a model of providing the advantages of national-wide electronic screen-based, scriptural and floorless trading system in a security. The institution is then accepted allows the transformation system of security through the online trading. NSCA, National Security of Indian Limited is today. Next, NCDS, that is National Clearance and Depository System, that is NSDR. Under the visual, the trading system is a settlement of transmission related to the securities take place through a book of entry. The entry prescription is a trading system is a comprises of following segment. National trading companies are reported the system which prescribe the terms and conditions of contract of a security market. National clearance system which they aims to determine the net cash and the stock liability of each brokers on a settlement date. National depository systems are arranged to provide a transfer of ownerships of security in exchange on a payment by booking of entries of electronic ledgers without any physical movement of a transport. That is NSDR, that is National Clearance and Depository System. It is clearing the dealings of national throughout the world. They are providing their clearing system. Who are purchasing the shares, debentures, bonds, securities, and mutual fund. These are being transferable to the third person within a day. And National Security Depository Limited is set up on 1996 for achieving the determination of rematerialization of share. And Stock Holding Corporation of India Limited, SHCIL. These are stock holding companies, and they are holding the stocks of the various companies, and they are providing their buying and selling of a business. Is then foreign exchange market. Foreign exchange market is the habit of exchanging of trade. Minimum the trade value is a $5 trillion per day. ஒரு நாளைக்கு $5 trillion என்ன பண்ணிருக்காங்க? They are currency exchanging the individual company, and both are participation in the foreign exchange market. It is a commodity exchange market. Commodity, which means a hot commodity and soft commodity. Hot commodity in sense of miles, coarse, onion, rubber, and oil. These are the hot, and soft is a food item, wheat, cotton, coffee, sugar. These are the soft commodities. They are buying and selling the hot commodities and soft commodities. And this is a derivative market in that they are providing the bonds, stocks, shares, securities, and currencies and foreign exchange. These are happening in the market. And this is your assignment. Make note of your assignment. Write a class of note for 81 questions. And your notes material in our school website, you can download it and make use of it and send the assignment through school app within the submission date. All the best. Very well. Thank you to all, and thank you.